What are the inheritance tax rules for your retirement? Imagine passing on your hard-earned savings to your loved ones and wondering how much of it they will actually keep. That's where inheritance tax rules come into play, especially when it comes to your retirement assets. So, what do you need to know about these rules? Let's break it down in simple terms. First, there is no federal inheritance tax in the United States. That means the government does not tax money or assets you leave to your heirs directly. But there is a federal estate tax that applies to very large estates. Currently, if your estate is worth more than around $14 million, you might owe up to 40% of the amount over that threshold. Most families, including many Asian American families, won't face this tax because their estates are usually below that limit. However, some states do have inheritance taxes. These taxes are paid by the person inheriting the assets, not the estate itself. The rates and rules vary widely depending on the state. For example, some states tax assets transferred to non-spouse heirs, while others do not. It's important to check your state's specific rules if you're planning your estate. When it comes to retirement accounts like individual retirement accounts and 401(k) plans, the main concern is how beneficiaries will pay taxes when they inherit these accounts. The Secure Act, which took effect in 2020, changed the rules for most non-spouse beneficiaries. Instead of stretching out withdrawals over their lifetime, they now generally have to withdraw all the money within 10 years after the original owner's death. These withdrawals are taxed as ordinary income, which can lead to a large tax bill if a lot of money is taken out at once. Spouse beneficiaries have more options. They can treat the inherited account as their own, delaying withdrawals until they reach their required minimum distributions. Non-spouse beneficiaries, on the other hand, must follow the 10-year rule. If the original owner was at least 73 years old, beneficiaries might need to take annual minimum distributions based on their own life expectancy during those 10 years. Missing these distributions can result in penalties, so careful planning is essential. The estate tax applies to the total value of everything you own, including retirement accounts, real estate, investments, and other assets. The top federal estate tax rate is 40%, but only applies if your estate exceeds the exemption amount. One helpful rule is the step-up in basis, which means heirs can reset the value of inherited assets to their market value at the time of death. This can reduce capital gains taxes if the assets are sold later. For Asian American families, understanding these rules is key to protecting wealth for future generations. Many families want to pass on as much as possible, so strategies like gifting during your lifetime can reduce the size of your estate and lower estate taxes. Making sure your beneficiary designations are correct on retirement accounts can also help optimize tax outcomes. Working with financial and tax advisors who understand both federal and state rules can make a big difference. Planning ahead for the 10-year withdrawal rule helps avoid large tax surprises, and estate planning tools like trusts can help protect assets and manage taxes more effectively. In the end, knowing how inheritance tax rules work can help you make smarter decisions about your retirement assets. This way, you can leave a legacy that benefits your loved ones without unnecessary tax burdens.